Dobar dan. That means good day. TalkCast PDX. Find us on the web, talkcastpdx.com. It's Tuesday. It's always Tuesday. November 16th, 2021. Name of the show is the Bogdanich Perspective. I'm your host, Paul Bogdanich, and welcome. It's episode 36. I'm going to call it Max Q in, ? Q is a letter, but it's an aerodynamic variable. It means maximum dynamic pressure for a rocket or a space lift vehicle. If you have a rocket where time to height, like if you're firing at an aircraft or something like that, max Q is almost always at motor ignition. If the rocket's pulling 20 Gs or something like that. But when you have men on board or sensitive equipment and you can't suffer that much acceleration, max Q happens somewhere, typically, somewhere as the vehicle breaks the sound barrier. And it's the most dangerous part of a flight. Like, I don't know if you ever remember watching the Challenger. It comes off the rail and then it does a rollover maneuver to put the weight right. And then it starts building speed. You can't crush the crew with a lot of Gs. And as it goes through max Q, you get a lot of vibration and you get a lot of... That's where errors happen. All right. The Challenger disaster, as it was going through max Q, they suffered a lot of vibration, kind of flexed it a little bit. And then an O-ring that was too cold to begin with failed. The heat jet lit the main tank. Boom. The shuttle that we lost on re-entry, that was when they come back through the atmosphere, they do a series of S curves to try and slow the vehicle down. And so on your re-entry max Q is where that one fell apart, lost a tile, and then it caused a cascade of other tiles and the vehicle burn up. So it's an aerodynamic term. If you have a problem at max Q, you usually lose the vehicle and the crew. And I'm just wondering, about our system, where's maximum dynamic pressure? It's a huge moving system and it's chugging along, so it is like a rocket in a lot of ways. Once you light the solids, there's no stopping it. Once you commit to reentry, there's no stopping it. So only hope that we make it through max Q. The only hard news for the week that happened last week was the PPI, which is Producer Price Index, and CPI, which is Consumer Price Index. And we'll look at those. Justin, if you can put up graph number 1. As is our habit, we look at the two compared to each other, and there's a reason for that. The CPI, which is the Consumer Price Index, typically lags the Producer Price Index. So price rises happen faster for producers than consumers and so on. And they always try and keep the CPI low because it's tied to the cost of living allowance, what they refer to as the COLA. And so it's understated. But the PPI and the CPI are good to look at together, and that's what we do. And here's where we are. The PPI, Producer Price Index for October, the headline number was up 0.6%. That's for a month. That's a 7.2% increase in a year. The CPI for October was up 0.9% for the month of October, and that's a 10.8% increase for the year. But remember, the PPI CPI lags the PPI. And if we look at the PPI, we had a bunch of negative numbers. Those are, the red ones in the parentheses there. So cereals and bakery products, beef and veal, pork, eggs, and passenger cars, prices started falling, and that's good. If you'll remember, if you've been watching the show for a long time, last 2 months, the rise in food prices was just absolutely disastrous. So those are coming back a little bit. We had moderate increases in the price of chicken, fresh fruits and vegetables, and apparel. We had pretty high increase in the cost of fish and shellfish, and this is all for producers. And then we had severe or alarming increases in the price of gasoline, piped natural gas, shelter if you happen to rent, and most alarmingly of all, alcoholic beverages. Went up 0.8%. That's just awful. 9.6% a year. Can't have that. Good report, all in all. You have the decrease in the cereal and bakery products, beef and veal, pork, eggs, like that. And so the tremendous cost of food inflation that we have been seeing for the past 2 to 3 months appears to be abating, and that's good news. You can take that graph down, Justin, and the increases in the cost of gasoline and pipe natural gas are severe, 6.7 and 3.8% for a month, respectively. A lot of people are arguing about the cause. I can tell you as a matter of distribution that closing pipelines and shuttering wells for whatever reason doesn't help, which is what we're doing. But those two things are still bad. I noticed, by the way, this happened. The consumer price index came out on the 9th, and the producer price index came out on November 9th, and then the consumer price index came out on the 10th. And if you look at they did an article in the Wall Street Journal, and they just talked about the numbers. Okay, but then Saturday, all right, which is basically only the people that get the Saturday Wall Street Journal, their subscription readers. And they did an article in the Wall Street Journal called "Inflation Helps Boost Profit Margin." And what that means is that all these companies that reduced portion sizes and kept prices the same over the last 3 months to try and combat the inflation, they're never going to get, and people that raise prices, they're never going to give it back. Even though their costs went down, they're never going to give the price increases back to the consumers, or they don't plan to. And it goes straight to, profits, because their prices are up and their cost of revenue now that the input costs are going down. And the Wall Street Journal, in its I don't know what you would call it, style, I guess, form, was just crowing about it. Isn't this great? They were saying we're going to totally, bend them over and just, make them live with the price increases for forever and ever while our prices drop. And so that's always interesting, I thought. Move to the markets. I'm going to read the creed again. Sorry if you're getting bored, but this sums up where I think the markets are at, and it's kind of integral to what I'm going to talk about. Looking at what's left of the bond market, lying in what's left of Wall Street, and wanting to earn more than 2% on our savings, we are functionally compelled to participate in the stock market. There simply is no other risk-free or low-risk alternative that pays more than 2%. Through our own fault, by assenting to the government spending as it was happening, as evidenced by our re-electing the same congresspersons year after year, decade after decade, we have contributed to the situation where interest rates can't rise substantially above 2%. This has resulted in the loss of our low-risk investment alternative we used to call the bond market. Artificially low interest rates also destroyed the former correlation that used to exist in between stock prices and interest rates. This disconnects the value of a share of stock from any calculable underlying value, and the share of stock becomes worth whatever someone else is willing to pay. More buyers than sellers make stock prices go up, and more sellers than buyers make stock prices go down. We further acknowledge that the Federal Reserve has been acting as a buyer of last resort. This causes asset inflation, but prevents the stock market from suddenly correcting to some unreasonably low level. Whether we like it or not, or agree with it or not, or are willing to admit it or not, if we want greater than 2% return, we are functionally compelled to participate in the stock market and are therefore reliant on the Federal Reserve guarantee. And that's my creed. I make a bunch of conclusionary statements. I outline the case for all conclusionary statements in episodes 1 through 9, with 9 being the most interesting. It's called The Knife Catcher. It talks about how the Fed got into the position of being the buyer of last resort. I think they're audio only, and they're available on talkcastpdx.com. But that's the underlying intellectual basis for all these statements, that interest rates can't go above 2%, that the interplay in between bonds and stocks that used to keep stock prices tamped down is gone. And so the only thing left is its character as an auction market and more buyers and sellers, giant popularity contest. And its prices are way up. Number of articles from technical wonk guys, like me. And if you track these things long term, last week, relative valuation in terms of all the hard measures, any hard measure you want to measure, share of the economy, revenue, earnings growth, forward, whatever you want to measure, all the historical metrics, the ones that were kind of on the borderline succumbed last week. And the current market valuation is above that of 1929, 1974, 2000, and 2008 on all measures. And there were a lot of articles about that. The Federal Reserve, twice a year, does what's called a financial stability report. And either last week or late the week before, they released their financial stability report. According to the Fed, the three main risks to quote-unquote financial stability are another surge or variant of the COVID virus, a stalling of the economic recovery, or investor risk sentiment deteriorates. And those are the three main risks that they see. And broadly, I agree with that. They break things down further, and they have categories that they look at, and they have four main categories, and I'm going to read just a little snippet from each category here. Category number one, asset valuations. Quote, asset prices remain vulnerable to significant declines should investor risk sentiment deteriorate, progress on containing the virus disappoint, or economic recovery stall. Unquote. In other words, investor risk sentiment deteriorates, resurgence of the virus, or stalled economic recovery would cause declines in risk sentiment. Category number two, borrowing by businesses and households. Quote, household balance sheets have benefited from, among other factors, extensions in borrower relief programs, financial stimulus, and high aggregate personal savings rates. Nonetheless, the expiration of government support programs and uncertainty over the course of the pandemic may still pose significant risks to households. That's a very polite way of saying that they kept all the stimulus going for upper middle class and better, and cut everybody at the bottom end loose on September 2nd. And in other words, the people at the bottom don't, anyway. All right, their category number three, leverage in the financial sector. Some challenging conditions remain due to compressed net interest margins and loans in the sectors most affected by the COVID-19 pandemic. In other words, money that was borrowed, their current revenue and income doesn't support the payments, and they have to do something. This is principally commercial real estate. Their category number four, funding risk. Quote, structural vulnerabilities persist in some types of money market funds and other cash management vehicles, as well as in bond and bank loan mutual funds, unquote. Those are technical problems directly attributable to the destruction of the prior bond market and the compression of interest rates down around 1.5%. So a problem of their own making, at least they understand it as a problem and they're watching it. In these conversations I talked about where everybody was talking about the market valuation, there's a Nobel laureate out of University of Chicago. Name is Richard Thaler. I'm not sure how he pronounces it, but he had a good quote. He said, quote, we seem to be living in the riskiest moment of our lives, and yet the stock market seems to be napping. I admit to not understanding it. I do not know about you, but I'm nervous. It seems like when investors are nervous, they're prone to being spooked, and nothing seems to spook this market, unquote. And then a commenter chimed in and said, such is always the case before something does, spooks the market. I'm not sure any of that's accurate. All these guys are going off historical parallels. We're in totally uncharted territory. As a practical matter, the Federal Reserve of the government has never guaranteed equity prices before. There's other differences. I spent a lot of time, thinking about it, the broader situation and how it changed over time. and, trying to explain the enthusiasm and thinking about, what's different or what could be different, and a new market force, just like a lead pipe cinch, investment opportunity, that you're going to make a ton of money on. And it's going to create tremendous enthusiasm in the market. And then that's going to, spill over into the stock market. And I think I found it, honest to God. Justin, if you could put up graph number 2, please. I'm going to wait till this graphic comes up. And there it is, Mr. Gox. Mr. Gox. Mr. Gox is a hamster residing in Germany. He's the founder and CEO of Gox Capital. His goal is to be the first crypto hamster whale. His executive office, which is pictured, up there, which he can enter and leave whenever he wants, is connected to his main living quarters. In this office, there is an intention wheel where Mr. Gox selects the assets he intends to buy or sell. After he selects an asset, according to his whim, Mr. Gox will move through either a buy or sell decision tunnel located next to the intention wheel. All of Mr. Gox's trades are live streamed with information about his recent orders and an overview of his assets. He also has a Twitter account named appropriately Mr. Gox, MRGOXX, and his performance reviews can be found on YouTube. Mr. Gox started trading crypto on June 12th of 2021. According to his business partner and caretaker, Mr. Gox trades in set increments, and his top crypto holdings include Ripple, Tron, and Ether. Mr. Gox initially incurred trading losses, but after complaining to his business partner that his computer resources were inadequate, his office was augmented with computer upgrades, and things have been coming up roses ever since. You can see the computer upgrades there. As of November 14th, 2021, just last week, Mr. Gox's portfolio was up 28.3% on trading just since June 12th, which is only 5 months. He has a store where you can buy hats and hoodies and framed portraits and so on. And the store is Stream Elements, STREAM Elements, all one word, .com /MR, no period, _ Gox, GOXX. Justin, you can take that down, please. But the hamster's up near 30% in 5 months. Being serious here. I did whole episodes about the way that money used to flow in between the bond market and the stock market, and that the P to E of a stock was equivalent to 1 over the interest rate in the bonds. And this used to cause a flow of money in between the bond market and the stock market, and it used to keep stock prices from getting too far away from underlying measurable characteristics, earnings and revenue and stuff like that. They destroyed the bond market through the borrowing for the wars and, trying to convert the Arab countries to democracy, and the bank bailouts, about equal amounts on each, $9 trillion each. But it seems that the need for something to juxtapose the stock market against still exists, whether it's psychological or not. And the bond market, preferred instruments guaranteed by law, safer, more conservative, lower interest rate. Now it seems to be crypto. And crypto has absolutely no underlying value whatsoever. Not a thing. It's totally sentiment based. Whatever somebody else is willing to pay. And it seems that the money flows into this asset class, out of that asset class, into and out of the stock market. Now goes to crypto. It's worldwide. So it has the advantage that if people in Singapore or China or Japan or Vietnam, those are your big gamblers, or the Arab states, get nervous about something in their own country, they can sell crypto and put it into the American stock market. So it's in other words, it's got big momentum behind it because it's not just domestic. And I think that has a hand in the high asset prices. And then you have the Fed trying to push the market up at 30% a year in the channel, and so on. Alternately, the high market valuations and the unbended, unalloyed enthusiasm, if you will, could just be a realization that the Fed's got a backstop on it and won't allow it to materially correct. They stopped the last little downturn at 5%. And if it somehow did get out of hand because of an external factor, what were the Fed's external factors? Surge or variant of the COVID virus, stalling of the economic recovery, or investor risk sentiment deteriorates. And if it did fall more than 5%, the belief is that it wouldn't last very long because they'd buy it back up, like they did. Or, alternately, if you don't want to overthink it and want a simple explanation, it could be a case of quas dies ult perdere prius dementat. Latin, a literal translation is those whom God wishes to destroy, he first deprives of reason. Popularized in the 18th century by a writer who put it, those whom the gods wish to destroy, they first make mad. Could be that. Don't know. Time will tell. 2nd century philosopher, a guy by the name of Sextus Empiricus. The 2nd century is when the Roman, in between 213 and 232 is when their wheels start to come off. And he was writing before this, but he once noted, he says, eventually the truth emerges and cosmic justice is rendered. The millstones of the gods grind late, but they grind fine. And it's interesting. You have to remember in the 2nd century, there was no monotheism in the Jewish tradition or the Christian tradition or the Mohammedan tradition. There was no monotheism. They had gods for this and gods for that. The largest temple in the world, the largest enclosed space in the world for over 1,500 years. The Pantheon in Rome is a temple to all the gods, built under, I think, Hadrian or somebody like that. But it still stands. But they're very secular, and it's kind of hard to imagine. But back in the 2nd century, 1st century, they were, in modern parlance, we might call it superstitious, I guess, but they were much more religious than we are. They had their secular things, but they're much more religious or God-fearing, if you will. So with that, let's look at the markets. Justin, if you could put up number 3, please. And this is just where we are. I've been showing this graph for the last, 3 weeks, 4 weeks? Since September 2nd, so longer than that, 6 weeks. Anyway, it's just the S&P 500 from June 30th to November 16th. You can see the market was going up in a channel. It hit a previous high on September 2nd, 45.37, and then started to have a few problems. Early September all the way into early October. Hit the low on October 4th of 4,300, which was 5.2% below the prior high. And then the Fed started supporting it at 43.60 there, bounced it off, wouldn't let it go any lower, and then it recovered on its own. And I think that crypto effect had a lot to do with that, because I think that when the market was falling, people were moving out of that into crypto. And then once the market stabilized and they saw that the Fed was going to support it, and I would point out it's the middle of November. We still don't have a nominee for who's going to be the Fed chair. There's 2 open seats, no nominees for those. Biden in his inaction could still kill this. But started to recovered the channel about 2 weeks ago, went right to the middle of the channel, fell a little bit last week, but closed last week at 46.83. That was as of yesterday. Today, the market's up 25 points. Walmart, you can take that down, Justin. Walmart reported today. They report late, as do some of your other retailers. Reported great earnings, revenue beats, earnings growth beats, everything else. Said they didn't know what was going to happen going forward, and the stock's down 3%. So revenue and earnings don't help that much. Elon Musk talking his own stock down and selling. I think he sold about $8.3 billion worth. Stock went up 26% in a week. He said, I'm selling. Took he's a very smart man. He's a hell of a good promoter. Got his investors involved in a poll on Twitter. He sold almost $10 billion worth of stock. For the week last week, Monday to Friday last week, the markets were down 0.31%, which is 14.68 points, woohoo. If you had a $100,000 portfolio, you should have lost 313. Our portfolios lost 1355, 1338, and both those portfolios were made up of the top 30 stocks by market capitalization. So mostly dominated by a huge fall in Tesla. Is why the extra $1,000 out of those portfolios. Top 3 every sector fell 1136. Same reason, Tesla. My portfolio was even, lost $36. Hedges returned 30, so I lost $7 net. If we look at the individual stocks involved, on the upside, there were 4 that gained more than 3%. Netflix up 5.75%. MasterCard up 4.2%. Not Visa, but MasterCard, and that's basically, it was sold off the last 3 weeks, and people determined that the sell-off was overdone. Sherwin-Williams up 3.9%. Didn't see any news, but Sherwin-Williams is a very interesting case. When I was being trained in college, back in a professional master's degree and that, back in 89, 90, like that, 87 through 90, somewhere in there, I used to read case studies, and there was a case study from the mid-1980s, and a PhD student in one of the disciplines went and looked at Sherwin-Williams, and Sherwin-Williams is the largest industrial coatings company in the world. Paints, sealers, epoxies, this and that. And he put together this entire paper that showed how Sherwin-Williams stock price, it's Sherwin-Williams stock price, used to be a lagging indicator for industrial production, and had been since its founding in the early 20th century, and just always trailed industrial production. Doesn't do that anymore. Opened up big retail stores, got another good promoter at the head of that one, and stock goes up. But anyway, they were up 3.9%. Abbott Laboratories up 3.3%. We already talked about that. Less COVID, more elective surgeries that are higher profit margin on their care clinics and hospitals and all the rest of that stuff. In between the stocks that went up more than 2% but less than 3%, UPS, Pfizer, Target, NVIDIA, Lind, Home Depot. No, Home Depot's up 1.15%. And then just a bunch of stocks, 13 stocks that went up but less than 1%. In there is Johnson & Johnson. Speaking of which, I forgot. Johnson & Johnson and General Electric and Toshiba. Johnson & Johnson and General Electric are the two biggest ones, American companies in the S&P 500, announced that they were going to split up. These are companies with different divisions, and they're going to turn the one company into 3 separate companies by division. General Electric, under Jack Welch, whenever you get a big celebrity like that, they're usually ruining the company and everybody's cheering them on. That's what happened with them. They were the ones that led the offshoring of industrial capacity, and it ruined them. and a lot of Americans in the process. But they're a shell of what they were. They have 3 divisions, powertrain, and we don't know what's going to be in it. But as far as a consolidated company, they have turbines for water, water turbines, jet engines, railroad locomotives, and nuclear power. And that would be their power systems division. They have a finance division, which they got into when they started divesting of all their manufacturing. That's a complete bust. And then they have a consumer product division, appliances, car parts, this, that. And they're going to split that into 3, and it depends how they split it into 3. But if the power systems division contains at least 2 of the 3 assets, that might be a good one. Because particularly their jet engine division is very, very good. Locomotives, small volume, but very profitable. And nuclear power, a lot of foreign, China's building 150 plants, et cetera. So, good revenue. Johnson & Johnson is a more interesting case. I had a guy 3 weeks ago or so write me and ask what I thought of these large legacy companies. And I said to him in an email, I didn't want to talk about it on the show, that the problem with them, General Electric, IBM, Boeing, et cetera, is the board of directors. They're elderly in age, old money, white shoe, stodgy, out of touch, convinced of their own infallibility, no vision. Like to do things to be popular. Sounds like I'm describing our politicians, but I'm not. They're the same. That's the root of this problem, is just letting these old guys run. We're killing ourselves here. But anyway, and you can't dispossess them. You can't get them out of there. But what you can do is you can come to them and say, hey, if we break it up, it's going to be good for shareholders, and you're going to be a hero, and you can still be the board member of this division and all the rest of this stuff. And they can talk them into doing that. And in Johnson & Johnson's case, and this is just my personal opinion, the largest shareholder in Johnson & Johnson is the Robert Woods Johnson Foundation or Memorial Trust or whatever it is. And the old man Johnson, who founded the company, when he died, left all his shares in the Robert Woods Johnson Foundation. And when you have an entity that large, once the founder's gone, the entity's first motive is to preserve itself. And they're smart, and they want to preserve themselves. And I think, personally, this is just my opinion, that they want to split off the pharmaceuticals division from the other divisions to isolate the other divisions from any potential liability coming from the pharmaceuticals division. Kind of a proactive move. Make sure that no matter what happens on that front over there, that the Robert Woods Johnson Foundation continues and they still have their jobs. And that's what I see as the motivation for that. But anyway, they're doing it. They'll have it done by the first or second quarter of 2022. And back to the stocks. 12 stocks fell, but less than 1%. In that group, you had Google and Bank of America and Facebook and Cisco and Chevron and AT&T and Berkshire Hathaway and JP Morgan and Apple and Adobe and Intel and so on. 9 stocks fell more than 1%, but less than 2%. And in there you have the oil companies, the other oil companies, ExxonMobil, ConocoPhillips, Honeywell, Walmart. This is a good one. Walmart reported, I told you about that. They reported earnings this morning, beat revenues, beat this, beat that. Couldn't tell what was going to happen next quarter. Stock down 3%. It was down 1.64% last week. So on top of the 3% fall today, that's almost 5% on a company that just reported record earnings and revenues and everything else. Southern Company, which is a railroad company. Then you had only 2 stocks down over 2%, American Tower Real Estate Investment Trust and Visa, the other credit card clearing company. Then 5 stocks down more than 2%. And ConocoPhillips down 4.1%. Nike, which is all China anymore, a lot of sentiment, 4.7%, no particular news. PayPal, 7.7% down. Terribly run company, talked about it a couple of weeks ago. Different problems. Disney, down 9.1%. Tesla was the big market mover last week, down 15.4%. Like I said, the week before, the stock went up 26%. No news. Oh, well, Hertz decided to buy Tesla cars as rentals, and stock went up 26%. Elon Musk said, hey, now that the stock's up 26% in a day for no good reason, let's sell $10 billion. Like I said, got his followers involved, took a poll on Twitter. Now he's using Bernie Sanders as a foil. I think he's sold about $8 billion to date, plans to sell in between 10 and 12. Guy's a genius. I mean, he'll, in terms of, in the last robber baron era, JP Morgan and Rockefeller and all those guys were ruthless and mean. This guy is going to go down with Hal Janine, tremendous promoter. Hal Janine was he was an accountant, and he rose up through the ranks of ITT, International Telephone and Telegraph. And he's the guy where Nixon got all the hush money. He used to bring bundles of cash to Nixon in the White House so that Nixon could pay the plumbers, back in all that in 1974. But that was Hal Janine, and he was a character. Everybody loved him. Good sense of humor. They broke his company up, of course. But now our Congress is bought and paid for and very corrupt, so we don't do that anymore. So I don't know. Anyway, we'll see what happens. Return to Mr. Thayer, but nothing seems to spook this market, and nothing does. Fed's major risks. Another surge or variant of the COVID virus. I think I can't talk about it. YouTube will censor me, so I won't. A stalling of the economic recovery, or investor risk sentiment deteriorates. Investor risk sentiment is a function of the other two, yeah? So we'll see what happens, but this strong belief that the Fed, has the back, so I don't see any reason to adjust things. I would point out, from my point of view, I'm mostly cash. Everything I have is hedged long. I have Facebook, 3M, Apple, and Microsoft. My options on those 4 stocks all expire on Friday here, November 19th, and I'm going to let them take them away from me. I'm going to let them go away with the calls and collect the cash, so I'll be about 85% cash. But I'm not making any money in this market, just waiting to see what happens. And start looking at the interaction in between crypto and the market. I think it made a difference. And go Mr. Gox. And that's been the Bogdanich Perspective for Tuesday. It's always Tuesday, November 16th. If you have a question or a comment, email me. Paul at StockBettor. That's Paul at StockBettor, BETTOR.com. And Dobajania. That means goodbye.
I'm Dave Dahl, creator of Dave's Killer Bread, a well-known, against-the-odds success story. Do To give back, we built a podcast studio called Talkcast PDX, a state-of-the-art facility to produce your own podcast. Talkcast PDX is a place where every opinion is accepted. If you've ever thought about it, do it. Use your voice and make a difference at Talkcast PDX.